Okay, so the Dow Jones Industrial Average was up 1,200 points today. The question is, how fast can you dance? Let's get right to it. This is the Hey Ed YouTube channel, and I am your host, moderator, and all-around nice guy, Edward Anderson. So I'm not a financial advisor. Don't construe anything I mentioned in this video as financial advice. Always do your own research before doing anything with your money. And I cannot believe I'm having back-to-back commentaries on the market because that's not really what I want this channel to be about. Even though I do have a Wall Street background, as a stockbroker, a trader, and a trading instructor, I don't want that to be what this channel is about because there's no end to what I could be talking about. But I've been getting a whole lot of requests to talk about what's been going on in the market lately. And this is kind of a unique / strange market we're in. And it's important to keep you kind of updated what's going on. But I also want to kind of infuse you with some of the lessons that I cover in my trading tricks videos. Because I do have a series of little trading tricks videos. They're little short 3 to 5 minute lessons about trading. And just to remind you, once you subscribe to my channel, if you click on this videos button, you can see all of the videos that I produce. And if you scroll down, you can see some of my trading tricks videos, right? Look for that blue background. And of course, if you go up the top here and click on the playlist button, then you can come down here, click on the trading tricks playlist. And of course, once you are here, you will see all of my trading tricks videos and you can watch them at your leisure. Okay, so not for nothing, but I used to charge a lot of money for the lessons that I impart in those videos, so you might want to take some time to watch them. But let's go over some of the lessons that I impart to you in my trading tricks videos and apply that to what's going on today. Okay, so one of my lessons is you never argue with the market. The market is always right. So forming a strong opinion about the market and then sticking to that opinion is dangerous. You have to learn to think like a trader, not an investor. Don't become emotionally invested. You're just looking to make money, right? So you got to be impartial. Just take a look at what the market is doing in front of you and then follow the trading rules in order to make money. Now, again, that's whether you're day trading or swing trading or an investor. I think everybody should think like a trader. Even if you're not actively day trading, you should still think like a trader. Okay, let's take a quick look at what this market has been like the past 6 months. Now, you can see the kind of swings that we've been having in this market just in the past 6 months. Very wild swings. And then you can see today that the Dow Jones Industrial was up 1,200 points in one day. A very impressive one-day move. Why did the market have the big move today? All right. Now, you got to learn to think like Wall Street. Okay. This is a game. Okay. You got to learn to look at reality a little differently as a trader than you would as an investor. Now, one of the rules you have to understand is that the market is a discounting mechanism. It's always looking to the future. It's not so worried about the current economic environment or the current technicals. It's looking in the future. All right. And so it's always trying to read the tea leaves. And sometimes bad news is good news. Sometimes good news is good news, and sometimes bad news is bad news, okay? You got to learn to kind of understand what is Wall Street thinking about. Because remember the greater fool theory, right? There's only one thing in the world that makes a stock, a crypto, a currency, a commodity go up and down. That's buying pressure. That's it. Buying pressure. If there are more buyers and sellers, it goes up. More sellers and buyers, it goes down. That's it. It's all psychology. Remember, you're not trading financial products. You're trading people. So you have to learn to read what the markets are telling you, what the other people in the markets are thinking out there, right? It's the greater fool theory, right? The idea being that if you buy a stock or whatever, you're hoping that there's a greater fool behind you who's going to buy the stock and drive it up more. Same thing to the downside, right? Okay, so with that in mind, why did the market go up 1,200 points today? When we know that inflation is at a 40-year high, there's all sorts of problems going on in the economy. So why did the market have this big rally? This is why. And this is the only reason why. So the CPI number came out this morning, and it surprised the street. And once again, the analysts got it wrong. These guys are not very impressive figures. They are routinely wrong in their predictions. And so today, the CPI number came in at 0.4% versus 0.6% that was expected. This is month over month. And year over year, it came in at 7.7% versus the expectations of 7.9%. So, okay, so the thinking is, right, that inflation might have topped out. That's your thinking. Boy, inflation is kind of topped out. Now, the big boogeyman in the market, the Baba Yaga in the market, has been the idea that the Federal Reserve will have to keep raising rates in order to fight inflation. I mean, after all, that is supposed to be their main job, is to fight inflation. So now the thinking is, well, if inflation is coming in under expectations, maybe they'll keep the terminal rate of at the federal funds rate at 4.5% instead of the 6% that they're kind of anticipating. So their thinking is that the Federal Reserve will start to pivot. And remember, the market is always trying to be one step ahead of everything else. They're trying to anticipate. They want to be in first, all right? So their anticipation is, their logic is that if the Federal Reserve is looking at the same inflation number that they're looking at, that the Federal Reserve will start easing their hawkish policy on interest rates. And so if they do that, then that's going to provide a relief rally. Remember, the market has been on a sugar high for an awful long time with really low rates. And when the Federal Reserve started to take away the punch bowl, a few months ago, that's when the market started to sell off, sharply. Well, now they're thinking, okay, well, the damage has been done. The market has sold off a lot because the Federal Reserve raised interest rates for a few months, all right? But now when the Federal Reserve starts to soften interest rates again at some point in the future here, the market's going to have a big run, and I want to be in first. And you have that kind of rush toward the door. So let's take a look. So stocks soared after fresh data showed inflation. Stocks soared after fresh data showed inflation eased in October, with the Dow Industrials adding some 1,200 points. Investors have been on the lookout for evidence that the Federal Reserve's interest rate increases are tamping down price pressures. They liked the latest data. All three indexes had their best days since 2020. Okay, so there you have it. That's it. That's why the market went up today. Now, whether the market is right in their anticipation or not, we'll have to wait and see. But again, we kind of don't care, right? We just look for what's going on in front of our eyes. Now, another thing to throw in is that in the past few trading days, the dollar has been pulling back. Now, the dollar has been on a tear. It doesn't mean the dollar is fundamentally strong. It just means it's the best smelling turd in the punch bowl, okay? It's just stronger than all the other currencies out there in the global markets. That's all it is. But now the dollar is starting to give up some ground. And the dollar and the stock market has an inverse relationship. So the dollar starts to come down, the market likes that, and the market goes up. So we have kind of a double whammy going on here. You also have a third thing going on here, and that is short squeezes. So anybody who was short going into today's announcement, because they're looking at the charts, they saw an awful lot of technical bearishness in the market, and they were short. I promise you, there are a lot of short positions out there. Well, remember, shorts make money in the opposite direction of bulls, okay? So when the stock goes up or the market goes up, shorts are losing money, right? Because shorts are betting on a downward direction of whatever it is they're shorted, all right? So when the market starts to go up, these shorts are running scared. So in addition to the regular enthusiasm, the relief rally that was going on by the market, you had the shorts who had to cover to limit their losses. And that created what we call a short squeeze. So I would attribute a good half of today's move to short covering, okay? That's not people buying out of any belief in the markets. They're buying because they have to cover their short positions. Okay, so again, I'm not giving financial advice, okay? I'm not a financial advisor, but listen, I can tell you that we are in a trader's market. I've been saying that for a while, and it bears repeating. We're in a trader's market. What I mean by that is this market is volatile. It's going to stay volatile for quite a while. When you've had this much trauma to the market in a short period of time, because even now, even with today's rally, the financial markets in general, in the U.S. markets, have still lost about $6.5 trillion worth of market value. So still a lot of pensioners out there, a lot of 401k holders, a lot of regular investors are still underwater quite a bit. You don't take that much damage in a short period of time and then just recover right away. There's going to be a period of digestion. That's just the nature of the beast. Now, bear market rallies are always the most violent rallies there are, okay? We are still in a bear market, okay? So, technically speaking, we've already had 7 dramatic bear market rallies just this year alone, since January, February. We're in the middle of another one right now. Now, whether this turns into a genuine recovery stage, we still need to wait and see. But what I mean by it's a trader's market is traders are like volatility. Okay, traders don't care whether the market's going up or down, because as a trader, you can make money in both directions. Traders just want volatility, and that's what we have. Okay, we have volatility. Investors have been very, very frustrated because investors have periods of relief rallies where they think it's all over and thank God things are going up, followed by another sell-off. Okay, that's been going on for quite a while now. We're not in a bull market yet. We still have a lot of technical damage to repair. So you have to kind of do some soul searching, decide what your plan is. Whether you're a trader or investor, you always want to have a plan, whatever your plan is. One of the main strategies that I encourage people to adopt is keep your losses small, let your winners run. And I use that with trailing stops, and I cover that in my trading tricks videos. If you haven't watched my trading tricks videos, please take time and watch those because you will learn things. And they're not complicated, they're very simple, but they work. Okay, they're good things to know. So where do we stand right now in the market? Well, let's take a look. Okay, so during this rally, including today's rally of 1,200 points, we're coming up right now into this very important overhead resistance level in the market at around, what is that, the 34,500-ish level. My expectation would be that the market is going to need some time to punch through that. It's probably going to have to do some consolidation, maybe pull back. It's going to need a little bit of digestion before it punches through. Now, could it punch straight through? Of course it could. Anything, could happen. But this was a catalyst move today. This is a move on the CPI number, on that headline news. The question is, what is going to be the next catalyst? Now, for people who are short right now, this market, right now, the shorts are worried. The shorts are worried about this level here being taken out. So if I had to guess, my guess would be that the market's going to have some kind of pullback right in here. And then we have to see whether it can punch through 34,000 or it revisits this 29,000 level, and time will tell. Now, another thing to keep in mind is we're coming up on the end of the year here, so there's a good chance we're going to get some tax loss selling going into the end of the year. So there's another thing to contend with, and we got another round of CPI numbers coming out in December, all right? So there are a lot of moving parts here, right? So the degree to which you want to be actively involved in the market on a day-to-day basis, that's, up to you, right? Personally, what I suggest you think about doing is hire out the trading. I use Novatech. You guys know by now, if you've watched my other videos, that Novatech is personally my favorite platform for generating passive recurring income. These are people who are traders, and they've been around for over 3 years. They've never had a losing week, and they average about 3% per week every single week. It's not the same number every week because they're traders, right? It fluctuates a little bit, but they've never had a losing week. Not one person has ever lost money at Novatech. So you should look at that. And of course, 7K metals, that's gold and silver, man. I mean, you're buying gold and silver, and you get not only do you get gold and silver, but you can generate passive income from it by building a small team. So those are just 2 small ideas, okay? If you want information on those, just watch my other videos on them or contact me. My email will be in the description below. Please give me a like if you don't mind. It doesn't cost you anything. And please subscribe, leave a comment. Edward Anderson signing out.
Copy that.